Free UK stocks to buy, August 2021 edition. Today I'm going to talk about the free stocks that I'm looking to buy in the month of August. It's a series that I've run on the channel for a very long time, and in fact it's actually the most popular video series that I do on the channel. So if you could smash the like button if you're new, subscribe, and yeah, I'll kind of spend a few minutes really through this episode talking about the free stocks I'm looking to buy and the reasons I'm looking to buy them. So without wasting any more time, let's take a look. So number one is Hotel Chocolate. I'm being a little bit lazy and just writing the ticker symbol instead of the full name, but yeah, Hotel Chocolate is what I'm going to talk about first of all, or the number one stock at the moment. And the reason why is because it's just come off a really fantastic earnings report, which we'll just glance through together in a second. But as well as coming off a really strong earnings report, the share price didn't move, and I kind of looked at that earnings report and I went, really, has the company not moved after that earnings report? And it was really impressive numbers, and I kind of compared that to another high street brand that I own, which is Greggs, and Greggs are kind of getting back to, you know, above CV numbers now, CV on the share price, but numbers wise the revenue is kind of in line to where they were, whereas this company is actually now even better than where they were pre-CV situation, and the share price isn't reflecting it. And I was like, there's a bit of a disconnect here going on with how good this company is performing, especially with the online growth they have right now, and the share price isn't really showing that. And I thought, you know what, this is a really good opportunity, and this is definitely one company that I'll be looking to pick up in the month of August because of its combination of high street opening up again now, which it hasn't had for last year, and how strong it's now, its digital platform is online. So yeah, number one is Hotel Chocolate. So Hotel Chocolate, ticker symbol HOTC. As you can see here, it's a 365 or £3.65 stock, and if you look at the share price, if you look at 2019 when it started to kind of build up its digital presence a lot more, it was kind of getting recognised. The share price was doing quite well, and then obviously we kind of peaked out around January time as the CV situation kind of came more obvious that it was going to happen, and then boom, you know, we had the massive drop in the share price. But even since the whole CV situation, this company is still 26% down from them highs, and even recently since December it had a bit of a peak, and once again it's down 21%. So you guys know me, I love looking at companies that are really good, that have a dip in the share price, and you know, I don't really like buying at 52-week highs, and I'm looking at this company thinking it's a great company, and I'm currently getting this on a bit of a dip from its 52-week highs right now. Now there is no P ratio there, but if it kind of goes around to do the profit that it should do, which is about the same as kind of what it did pre-CV, then we are paying a little bit up for this company. We're going to be paying up about a 30p ratio, which is a little high. I agree, it's a little high, but it is a great company. And as well as that, when you look at what it has going on for this company, you can understand why you're paying up a valuation a little higher for this one, and the growth, the profit, the balance sheet it has, it'll all make sense when we take a look in a second. But in case you don't know, they do sell chocolate products, so you can, obviously they have the stores on the high street you might have seen, but they also have obviously their online business as well. Some of these can be just buying like the individual chocolates, or one thing that I like to have, which I cannot spot right down here, I'm just scrolling through the website with you right now, but it is the Velvetizer. So there we go, here it is, the Velvetizer, and this is a product that I actually use, and I think it's a really fantastic product. I don't use it as much when it gets to summertime, but honestly, one of these drinks after being outside in the winter when it's like being like -1 Celsius, which seems so strange right now, but while we're in summer, but when you've been out all day and you have one of these, honestly, really amazing hot chocolates. And yeah, I mean, people can buy them for themselves, or they might buy hampers. They actually do now like a subscription bundle that people are quite into, and yeah, they're really looking to expand a lot of the product range as well. So overall, I like the brand, I like the product, and I use them myself, which is also a bonus, I guess. Now, just popping into the recent financials, it was, like I said, a really strong earnings update, and the company hardly didn't move. Just a little shout out here as well. I don't know if you saw Airtel Africa's earnings as well today. They were actually really strong. But anyway, getting back to the free stocks to buy. You see, I get distracted so easy. Look at Hotel Chocolate. So I think what we have right now is, if we look at the financial year 20, it's a 21% increase, which is really impressive. But once again, I think this is even more impressive, is that, and that was really good because in the whole CV situation, they were so good growing their online presence that they still had decent revenue. And kind of like were in line of where they were, you know, pre-CV, and they also didn't lose a lot of money. But What is even more impressive now is in financial year 21. If you look at the last financial year where they kind of had, the shops open and everything, they're actually increasing 24%, which is so impressive. 24%. Like, I thought this, this is a good company with like a 10% growth, but they're actually growing at 24%, which is so impressive. And this is what also increases the UK customer database by 66% because of their online sales. What they're doing now is they're actually expanding into the US. So if you look here, product sales increased by 62% in the US. And also if you look at Japan, joint venture partnership grew sales by 277%. So this is the big thing that Hotel Chocolate has right now. Previously, 2019, mostly brick and mortar stores. Now what you have is a combination of this beautiful thing of brick and mortar stores, an online presence where online sales are growing a huge amount, and then you're expanding into the US, which is growing huge, and then you also have Japan sales, which are growing huge. So this is the big thing about this company right now, is they're growing. This is like buying a little bit of a mini growth rate. It's a bit like a Greggs, but Greggs back when it had hyper growth. And that's something that I really like. This is what I'm really like about this company, is that, it's not just a brick and mortar store, which they haven't had them sales for last year, which are now coming back in, which is great. But you also get the digital side of it and the international growth, which I think is amazing. I think this company is going to be on for a big 3 or 4 years, in my opinion, coming up. And like I say, it's on a big massive sell-off. And sure, you're paying up for a little bit of a premium at a 30p ratio, but I think when you look at the growth it has, I think this company is, if you look at Greggs has always traded at a bit of a premium. I think this deserves to trade at a bit of a premium, and I think as well as that, the growth is fantastic. Just going to flick across to financials for Simple Wall Street, and if we just go on the future growth here, you can see here it's historically grown decent on the profit, and it's going to grow a little bit quicker here, but still, I don't think Simple Wall Street's kind of pricing in the correct amount of growth which they are going to have. So I think revenue growth, profit growth are going to be fantastic. Financial wise, they have just raised a bit more money to try and keep up with how fast they're growing. But still, balance sheet wise, it's fantastic. The debt that they had on there has pretty much been paid off in 2018. Very strong debt to equity. So yeah, nothing to worry about on the balance sheet wise, and still sitting on a 47 million cash, and I think the company is worth about 500 million, which is very healthy as well. They did used to pay a little bit of a dividend. We'll see if that does come back. I think while they're in hyper growth stage, we might not get a dividend at the moment, but it might come back at some point, so you can consider that as well. And one thing that I do like as well is when we do look at the insiders and the ownership of the company, you've got a strong insider holding here. So you've got a co-founder here still holding 27%. You've got the CEO, which is the other co-founder, holding still 27% as well. So yeah, between the two co-founders, they still own half the company as well, which I think is a massive sign of confidence in my opinion. So overall, yeah, I'm really liking Hotel Chocolate at the moment. I hope the international expansion keeps going well. I love the combination of having brick and mortar, digital as well. In my opinion, a great company. And at the moment, it's kind of had a bit of a 3-4 months period where it's kind of flatlined, which is great because I just keep building up my position up more and more. If it has the odd little dip, I can just nibble and buy a few more. So yeah, at the moment, while it's down here, while it's at these sort of prices, I just keep adding into this position, and yeah, it's one that I'm definitely quite confident on. And yeah, the longer it stays down at these prices, the happier I am, because the company is doing very well financially. And yeah, if I buy more and more, it's just getting a bit of a bigger position. It's not broken into the top 5 just yet, but I could see this now coming a position that is probably my 4th or 5th biggest in the UK holding, behind the classic S4 Capital, Boohoo, Greggs, and Hollywood Bowl. I could see it coming in, taking that 5th place maybe. So we'll see what happens there. But number 1 is Hotel Chocolate. Number 2 is a company that has not made this list for, I believe, a year. It's been a while since I featured this company, but it's Boohoo. Yes, it's a company that used to be my biggest holding until S4 Capital came on the scene and overtook it. Also, I've kind of released a couple of profits here and there with it being a bit of a volatile stock. I always don't mind releasing a bit of profit even though it's a long-term investment, but at the moment, Boohoo shares are sinking down on the share price, and they are kind of now got to a point where I was like, it was been at like at £2.90 for a little bit, and then it kind of dropped to £2.80, and I was like, this is getting quite tempting now. And then £2.70, and I was like, okay, this is probably time where I consider buying a few more shares in Boohoo. Overall, the big thing that Boohoo has had, it's, like I say, it's been very choppy. There's times it's gone up, there's times it's gone down. It is volatile, and it also has a lot of media pressure on it. It is very, quite often, especially last year, has been under a lot of scrutiny from a lot of the media, and it hasn't been the best behaved company sometimes, and got caught up in some scandals, which sometimes you can argue is probably not to do with the company directly, but they should have probably managed them positions better themselves, with a lot of like factory situations where the company was getting a lot of their products made, and yeah, a lot of 2020 had a lot of media pressure on the company. 2021, we're looking at this company now thinking, okay, can it kind of stop that now? Can it tighten it up and make sure everything is, or a lot of its customers that it is using or suppliers it's using, kind of make sure that everything is legit and we don't get caught up in a lot of media headlines. And that's a big thing we're looking at Boohoo right now. And 2021 has been a lot better for Boohoo, and the media have been staying away a lot more from this one. It has had obviously a poor 2021 on the share price. I believe a lot of this is due to guidance. So I think when we had a bit of an earnings update, which I believe was February, they came out and said we're only projecting to grow at 25%. So for a company that kind of historically grew at 30+%, I think everyone kind of went, okay, that's not normal growth for Boohoo, and that kind of spooked investors, made them a bit more nervous, and that kind of left the share price to go down a little bit. And then recently it's had a bit more of a slump, and a lot of that is kind of due to another company which isn't obviously Boohoo, which is ASOS, and ASOS came out and said they kind of are predicting not very good growth, and people looked at that at ASOS and pretty much thought Boohoo would be the same. At the moment, Boohoo have been clear on the guidance that they still think they're going to achieve 25% revenue growth, and yeah, people kind of took ASOS and took it to Boohoo, and yeah, they kind of got punished for another company's outlook, and people were worried that the same thing would happen to Boohoo. We'll see what happens. Obviously, Boohoo reported before ASOS's earnings, so that might be something that's happened recently to Boohoo and we might not know about it. But those are kind of the two main reasons which are kind of pushing Boohoo down at the moment. But we'll just take a look at the share price right now. So you can see here now £2.66, which is very tempting for me. I'm currently sitting on an average of £2.40. And if we just go on to a 5-year chart, you can see this company is very volatile. So normally, previously when it's had this dip here, I've bought. When it goes up, I've trimmed a little bit of my position. Once again, it's tipped. I bought. It's gone up. I sold a bit of my position. And yeah, you can see here this sort of it's kind of been a bit flat really, and it went into 2021 actually pretty strong, and yeah, it's had a 26% dip since the turn of the year, and yeah, a lot of it, as this here was kind of due to the kind of weak guidance, which wasn't a huge drop, and then boom, the recent drop was a bit more because people were worried about if the sales are going to be weak. So I will be kind of honest, the shares that I'm kind of looking to buy right now, I am kind of thinking that I will probably sell around about £3.50 range. So this probably what I am kind of buying right now is a little bit more of a shorter term play than what I normally do. But I do think it's a good little opportunity to be adding a few more shares. And the good news is recently what has Boohoo been doing? They've been acquiring a lot of companies. They've been acquiring a lot of companies that have struggled through the CV situations. One of the big ones is to pick up Debenhams, which I think was a lot better than picking up Topshop. They bought it for a lot cheaper. It has a lot of a really good online presence, and as well as that, what helps Debenhams a little bit more is that they're now able to enter different sort of products they sell. So I think that makeup could actually be a very good addition to what Boohoo is selling, what they don't normally do. And if we just go into the recent earnings update, it was still very strong. If we look at what the UK was doing, we're still growing 50%. The rest of Europe and rest of the world were a little bit weaker, but US sales were still pretty strong, and overall we had strong revenue growth of 32%, which is what Boohoo normally does, grow in that sort of percentage, in that 30% rate, and they didn't change their outlook, which is a big thing. So they're still kind of, if you see here, they're still looking at 25% growth. So we'll see if they kind of raise that at some point, but at the moment they're still a little bit ahead of it. And the big thing as well is that we have right now is we kind of have everything opening back up, and maybe holidays come in at some point, but what can you do now? We pretty much can go anywhere. There's no restrictions. You can go on a night out now as well, and if there's a lot more going out, there's a lot more events like festivals, for example, nights out. I think obviously Boohoo is more aimed at the younger generation, and what they're going to do if they're going out a bit more is they'll probably update the wardrobe. So I think this the whole economy opening up as well will help Boohoo going forward as well. Just a quick flick through the financials as well, just really quickly. If I just go on the future growth, you can see revenue growth is so strong for this company, and even though it does trade around about a 30p ratio, it doesn't take long for this company to get cheaper and cheaper when you're growing at this sort of rate. And as well as that, even with the high investments that they've made, they still make good amounts of profit as well. You know, the amount of companies they've kind of been buying out recently to add to what they have has been pretty good. And even doing all them company buyers out that they do have, they can afford to do it because balance sheet once again is really strong, no debt on the balance sheet. And if you look at the cash here, they've got 276 million on cash as well, so they can afford to kind of buy out all these companies and kind of keep up that growth going. So yeah, with Boohoo at this sort of price range, it does really tempt me at this sort of price range where I kind of pick up a few shares. And like I said, to be honest with you, the more shares that I am kind of buying up at this sort of range are probably shares that I will kind of maybe sell a bit more in the shorter term, probably around that £3.50 range. But we'll see what happens. You never know. A lot can change, but that's kind of a plan right now. So yeah, I am looking to pick up some more Boohoo shares at this sort of price range. And number 3 is best of the best. So there's a few stocks that I could have put in here at number 3 spot, and then some of the house builders look very interesting. National Express, Jet2 are quite volatile because of this Delta variant pressure that's on them. Some of the house builders as well. The house builders have sold off quite a bit recently, and they're really great growth stocks with dividends. So any of them sort of companies could have taken the number 3 spot. But at the moment, I'm going to give number 3 to best of the best, which is a company that I'm kind of buying in at the moment. What's kind of happened with this company is that they've kind of had a big massive explosion as they've moved to an online business model only, and they grew at a huge rate, and the CV situation helped them, and now there's the kind of correction coming in where people have realised, okay, we're back to normality. Best of the best aren't going to grow at this rate normally, but when everything kind of levels out, you're still going to pick up, in my opinion, a company that has good growth, a little bit of a dividend, a strong balance sheet as well, and is at an incredibly cheap valuation. So we'll take a look at that one. So just take a look at the share price here. It is a small market cap company, so just be very careful of this one. A little bit of a tip, I always need to remember to shout this one out. If you are looking to buy this on Trading 212, could be a bit of a problem because of the market cap size. Personally for me, I always buy this on DeGiro because the orders always seem to go through a lot more quicker, and also a little bit better on the spread as well. But anyway, going back to the best of the best, so ticker symbol BOTB. Once again, I was a bit lazy writing it on the whiteboard, but you can see here this was the big jump because financials were performing excellent, and they moved to being more located into airports to an online business model only. Ended up with the share price performing very well, and then people realised, it can't do this growth all the time, and people are kind of panic selling out right now, which is, once again, as you know, I love picking up companies when they're selling off the 52-week highs, and I look at the company right now, and if you look from April time, the company's lost half its value, which is now for me a time, over the last few months I've been buying this one, and it seems to be, if I can just zoom in a little bit more, it seems to be just leveling out a little bit now around this sort of price range. So while it's around here, I'm just slowly building a position. I've got to say, this one probably won't be as big as a position as some other stocks in my portfolio, just because I feel the moat is quite small on it, but I am seeing a bit of an opportunity here in this company. Now, if you look here, this company's a 12p ratio, which is incredibly cheap. Normally for a company at a 12p ratio, you're kind of thinking, okay, it's probably got a probably 2-3% growth, which when I show you what numbers they're actually putting in, you'll be like, okay, that's incredibly cheap. And like I say, I'm picking this up as a little bit, I think the share price is undervalued, but as well as a little bit of growth, my plan is that they're going to be growing the dividend a little bit further down the line as well. So if you don't know what they kind of do is, what a nice looking car as well, by the way. They do weekly competitions, which is like spot the ball. So you pay your ticket, you try and, it actually says here, you spot the ball where you think it is, and then announce the winners, and you might win what they do. They do this, the main thing they've ever done is like a luxury car here, but they've actually added in other competitions as well, which are prizes that are more like luxury items as well. So yeah, all pretty good from that point of view. Now, if we just go into the recent earnings, you look at revenue here, 45 million compared to 2020, which is 17 million. You know, absolutely crazy growth. This is why the share price has run up, and people are kind of thinking now they can't do that sort of growth, and that's why the share price is selling off, which I don't think they can carry on growing at that sort of rate at all, but it's a very good jump, and you look at the profit as well, really good jump in the profit. It also led to them paying a really nice special dividend as well, which is great. Now that obviously is a special dividend and won't get paid all the time, but I feel like because they are now making that much more profit, then we will see either more special dividends to come, or they will hike up the dividend as well. It's also worth saying this company is very good as well at its social media following. They have great social media followings, and if you look, if you ever search best of the best in Google, I honestly will tell you right now, it will not take long until you have pop-up adverts of best of the best on Instagram and Facebook. And yeah, they're growing a really good social media presence as well. And I feel like the more they take this company more worldwide as well, it could really grow its revenue and profit as well. Now, just going onto the Simple Wall Street, where we'll just go through some numbers here. So you can see here, this is the financials, and historically when it was just based at airports, it still did very good on growing like revenue. Profit was still pretty decent, and then you can see the jump up here. And going forward, the company is still expected to grow at a decent rate. Obviously, Simple Wall Street are kind of predicting like a 20% growth here, and about 20% growth on earnings as well. Personally, for me, I don't think they'll grow that fast. I think they're going to grow around, in my opinion, about a 10% revenue growth rate and about a 10% profit rate, which I still think is very good for a company at a 12p ratio. So I think that's going to be good for the company going forward. On the financial health side of it, very strong balance sheet, strong debt to equity once again. Zero debt on there. It's got 11 million on cash, which is good. And the thing is the more that this company kind of makes more and more profit, that's just going to sit on this balance sheet here. So like you say, like I think I showed you just a second ago, if we just go here, they actually made profit before tax was 14 million. So I mean, obviously they've got tax on that, but if we just say, 14 million, for example, then that would just, go straight onto the balance sheet as well, which means we just get a stronger balance sheet every year. It does say a 6% dividend. Obviously, that's got the special dividend in, but I do feel like they will up the dividend going forward, because the big thing that you do have here is a 4% payout rate. So this company could, right now is, they could easily up that dividend payout rate to 8%, 12%, and he's still got plenty of cash there. So I'm looking at this company now, going back to where I was at earlier, which is a 12p, and I think, if this grows at 10% a year, which, like a Greg's, for example, and that gets to trade at a 30p ratio, for example, I think it's incredibly cheap from that point of view. And from a dividend point of view, I feel like they'll up that dividend as well, which will also attract investors. And I think it's just a phase now where it's kind of just correcting after that big jump, that really good year. And it might be a bit flat line for the next 12 months, but I think in the next 5 years, as it just steadily keeps improving, I think everything will be quite good with the company. And just on an ownership point of view as well, a lot of insiders holding. There has been a little bit of selling, but I think that's fair enough, because like I said, like I showed you earlier, if we just go back to where we were, if you owned a stock here and you aren't used to these sort of moves in the company, and then all of a sudden, boom, you go like this and you're up 700%, I think most of us would go to the point of view is like, we'd probably sell some of our shares. So yeah, I don't really blame any insiders for actually selling some of the shares, but it's good to see that they still have quite a big stakes here. So you got this founder CEO here, which still owns 32% here, and yeah, you got 9% holding here, a 5% holding here, which is pretty good. So yeah, overall, yeah, I don't blame them too much for selling. It's just good to see still a big, massive ownership in the company, and still that that we still have a founder-led company, and the CEO still holding a big stake. So that makes me quite confident. So yeah, overall, I think this is probably on the list here that probably will be kind of, I think this will be down at these sort of prices for a little bit, which is good because I get to build up a bit of a position, and it is a volatile stock as well, so there will be days where it moves around quite a bit. So yeah, it's a company that I'm kind of steadily building my position into, and yeah, I think I'll have a while to do it, and I think it's a good little opportunity, and I wouldn't even be too surprised as well if this company here was a company that was to get bought out further down the line as well, which I could see happening. So yeah, those are the 3 UK stocks to buy August 2021 edition. Hope you enjoyed it. Let me know if you're buying any of these. Let me know what you're buying as well. I'm always interested to see you guys and your thoughts in the comment section. But as always, smash the like button, subscribe. If you do want to know when I'm buying and selling companies, make sure to join the Patreon. Link is in the description. And if you do want to start investing, there's some links to some brokers in the description as well, like Free Trade, like Stake. You join through there, you get a free share. But that's the video for today, guys, and I'll see you on the next one.